Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. Today is Friday, August 30th, 2024. Notably, today is the last trading day before September starts, the famously volatile month. It's also a Friday. It's also a Friday before a 3-day long weekend for Labor Day. So a lot of weird things can happen out of the ordinary on a day like today. And we may have seen some of that going on. End of the week, end of the month. So certain traders use monthly time frames. Certain money managers need to have certain results by the end of the month. Options trading strategies, a lot of options expire on Fridays, traditionally the third Friday, but still a lot of options will be expiring here as well. Also, sorry I missed yesterday's show. I couldn't do Thursday, didn't have time. Today's episode, I'm going to start by reviewing Thursday's main data. I wrote a note in the community tab, and I'm not sure how many people of my regular viewers saw it, but basically Q2 GDP second revision. I said on Wednesday I thought that this might come in with a negative 0.2 revision, which would help the bear case. Typically at the beginning of a recession, you get numbers that are revised lower from the GDP, as seen in the article that I shared in a few shows ago. The expected loss was 2.8%. Instead, we went plus 0.2%, and so the revision came out to be 3%. So that's obviously an indication that that number alone says the economy is strong. But remember, this is Q2, and it's important to realize that all data, practically all data is like lagging data. That's what happened before. The key is to figure out, what's happening next. And leading indicators, such as the SOM rule, such as the yield curve inversion, which actually the 2-year, 10-year, we can open a bottle of champagne, sort of. We went flat today. I believe today was the first day that I've seen this where it's actually flat. We'll talk about it a little bit. And this is actually a very good leading indicator. We'll take a look at that chart actually. If you've been watching my show, you've been noticing for a while now that I've been noting how the 2-year, 10-year Treasury yield curve was inverted for over 2 years. Pretty much never happened before. This is like Great Depression kind of leading indicator. And just today we went flat. Now, so it's not inverted anymore. That's a good thing, right? Not so fast. This is how it works. You invert, you uninvert, and then this gray bar here, you get a recession. Let's do it again. Wash and repeat. We invert. In 2000, we stay inverted for a little while. We uninvert. What happens immediately after? Gray bar, recession. I wonder what's going to happen the next time. We invert very briefly, uninvert, and then invert again for a little while here. We uninvert. We invert for like a month again, and then we clearly are out of the woods. We're uninverted, and what happens? The great financial crisis. All right, so it's actually when this uninverts when the recession usually starts. And today, exactly today, if you look to the right side of this chart, we hit zero. This is updated for today, end of August, is 0.00. This is on the Fred chart. You can look it up yourself if you don't believe me. 10-year Treasury constant maturity minus 2-year 10 Treasury constant maturity. I didn't need to read all that. It's the T10Y2Y. And yeah, so we are at zero after being inverted. And look how deeply we've been inverted and how long we've been inverted. This doesn't happen very often. And when it does, coming out of the inversion is when the stuff hits the fan. Now, why is that? Well, so the if it wasn't going to lead to a recession, it would uninvert with the long end going up over the short end, but we don't have that. It's the short end that's dropping below. And so what it's saying is that the T-bond market is predicting that there are going to be a lot of cuts. Within the next 2 years, there's going to be enough cuts so that the Fed funds rate will be below the rest of the curve. I've been sharing the U.S. Treasury's yield curve on many of my shows, and, admittedly, I had kind of not been paying attention to specifically the 2-year and 10-year because of the 3-year, the 5-year, and the 7-year. Now, the reason that those yields are lower, I remember learning about this before, is that they're just not as popular. I don't think they're as liquid. They're not as used for business. It's a complicated thing. Let's just say they're not as popular. But yeah, I got thrown off by the fact that it's still clearly inverted all the way out to the 5-year. But yeah, and then going out to the 10-year, the 10-year and the 2-year are actually flat here, exactly flat. And now I've been saying, I'm waiting for the 3-year to drop below the 5-year, 2-year to drop below, and eventually I expect that to play out that way. It seems to be going in that direction. But yeah, the recession, it's here now. So, but Mr. Market doesn't care. It seems that Mr. Market cares about the GDP is strong, and that is a good thing. That means the economy did not completely fall apart for the second quarter of 2024. So, from March through June of this year, strong GDP. That's a positive thing. Mr. Market today, along with it being the end of the month, end of the week, end of August, going into September, we also had PCE come out today. So PCE came in exactly as expected. Regular PCE index, month over month. The last is over here, 0.1%. Expected and actual at 0.2%. PCE year over year, flat 2.5, 2.5, 2.5. Core PCE, 0.2, 0.2, 0.2. And it looks like the core actually was slightly lower. Practically exactly on point here. I expect these numbers to drop in the next readings of this. I expect these actually to, believe it or not, go negative within the next few months here. But for now, inflation is still, it's not out of control to the upside, and it's not negative quite yet. Last main thing on the agenda, S&P 500, strong green candle, but not enough yet to be bullish exactly. This is the S&P 500 SPX. As you can see, we closed. This looks like a bullish candle. It looks like even a sort of a breakout. It is sort of a mini breakout here. But notably, we did not close even above Monday's high, which means that topping tail is still in play, suggesting that this actually can easily be the top of this little hill here. The other thing is that we didn't close above the high. This isn't an all-time high. The all-time high was back, let's see, July 16th, it looks like. And so we still, for this market to truly get bullish, we do need to see a little more strength before I'll throw in the towel, eat my own hat, and say, well, Mr. Market is, I'll just say he's going to do what he's going to do. Who cares that the price has gotten so high that we are now at over 29 PE ratio on the S&P 500. Again, looking back in history, even when you have earnings contractions that spike up the PE ratio, we never even get that high. And like I've been saying, we haven't even seen contraction of earnings, and we're already at a epically expensive price in the S&P 500. I've mentioned it before, I think it's worth mentioning again. You take out the Magnificent Seven away from the S&P 500 and that number is nowhere near 29, but the amount of wealth and the amount of market cap that the S&P 500 has in those stocks make those stocks have a lot of control over the entire market. And you know, passive investors have an enormous amount of their own money in these Magnificent Seven stocks because a lot of people have the index fund, the S&P 500. Not everybody does, but a lot of people do. And considering the market caps, the size of the market caps, there is so much wealth put into these companies that, yeah, it brings the entire S&P 500 up to almost 30. That's not something to be comfortable with, let's say. This is similar to what was going on in the dot-com bust, with there simply being too much money in things that are too speculative, that are just very speculative. This is not a healthy market right now. And if it crashes, it can take everything with it. You know, the wealth effect can contribute to inflation. When people think they have more money, they don't mind spending more money. When you have a contraction of perceived wealth, that's why we get these recessions that kind of tumble on top of each other. People don't want to pay more, therefore people don't want to hire more, therefore people, earnings of companies are going to be lower, therefore asset prices have to drop there, and then nobody wants them. You can't find any to buy them, so they drop further, and then that makes the wealth effect happen again, shrinking more and more and more, and it rolls on itself. That's how these things play out. So this is the right time to be very, very scared of the equity markets, in my strong opinion. I'll add one more piece to that. The whole point of inventing stocks in the first place was to distribute ownership between people so that everybody has a piece of various businesses, so there's less risk if you own, just one whole business. You can spread it out, and it gives the opportunity for smaller investors to own a piece of the pie, to own a piece of the ownership of production of things. Now, another problem that I've brought up in many videos before that I will bring up again now, is that when you own a company, the company is supposed to pay you some of its profits. That's how this works. Why would you want to own a company unless you're going to be getting some of the profit? So many companies are using all of their profits for buybacks, for investing back into the company, paying the CEO, the people that work there, enormous amounts of money. All of that combined, puts all of the weight of ownership of companies in the market price of the companies. Now, unfortunately, that's how Ponzi schemes works. If you're not getting an actual return, if they're not giving you the money that they're making and just saying, oh, don't worry, we got this money, we're going to turn it into even more money, don't worry about a thing, and they're taking a lot of their profits and buying back their own shares from the secondary market, this is going to blow up, in my strong estimation. When a stock price relies on its stock price and not its value, not its return, there is just so much speculative value in the US stock market right now that it is absolutely terrifying. But what do I know? I'm just a guy with a crystal ball. Look out next week for Wednesday job openings. The last rating of this was 8.18 million. It will be interesting to see if this starts contracting yet. And then the real big one. This could be like a historic day. Next Friday, the unemployment rate, last reading of this was 4.3% when the SOM rule was triggered, meaning that the rate that people are losing their jobs at is going up at a rate that is very fast enough to say, yes, we are actually in a recession right now, even though it's only 4.3. Now, Fed Chair Jerome Powell, in his speech after Jackson Hole, said explicitly, I think his words were, we've shifted our focus to be worrying about inflation to saving the labor market. He said we don't want to see further cooling. In other words, he sees cooling. He sees that it's a problem, and therefore that's why they're going to be cutting rates in September. This could be the report that because they get the numbers. The numbers are coming in for these things before anybody sees it. He probably already saw this report. He probably already knows that the unemployment rate, the jobs data, the non-farm payrolls report, when we finally tick down, that's like it. That's like recession time. This Friday is when that data comes out. I will not be surprised to see non-farm payrolls contracting and unemployment rate continuing higher from here. The worry has been inflation. He doesn't want to make the mistakes of the 70s, however you want to think of that. That's been the narrative forever. We will not let inflation get out of control. And now he flipped. He said we've changed our focus. It's changed. We're in a different game now. We're trying to save the labor market. That's what he said. Now, is this because he's trying to somehow make sure there isn't like too much weakness going to elections? Like, we don't want a recession during elections because that's bad for everybody, kind of a thing. I don't think so. I think that, this Friday will be the ultimate truth, right? So if unemployment drops from 4.3% and we see non-farm payrolls actually expanding here, people will be scratching their heads saying, what? They're going to cut for what? What further weakness was Jerome Powell talking about? I don't think it's possible actually for this next Friday's report to come out friendly. I think it's going to be the straw that breaks the camel's back. They're saying they're cutting in September. They're saying it's because of the labor market weakening. I mean, how could you be more clear about this? You can't. This is what's going to happen. No advice. I'm just the guy with a crystal ball. Again, we already did the daily reminders. 2-year 10-year is now flat, about to uninvert, suggesting, okay, yeah, the recession is starting now, basically, or extremely soon. It's imminent here. Also, SOM rule triggered. Recession has started. I'll say one more time. Being inverted for 2 years and very deeply inverted for 2 years is a sign that this recession might be pretty bad, even maybe the first depression in 100 years. Again, depressions used to be common. They used to happen all the time. We haven't had one for a long time. I think I've made my point and my sentiment on what I think is going on. We're going to move on through the charts. This is the triple Qs, the NASDAQ 100. As bullish as the S&P 500 looks, the NASDAQ, funny enough, is still a little bit more clearly in this head and shoulders top formation. Oh, and I forgot this one. This is a weekly time frame of the S&P 500. So the week just ended, and this actually makes it look more clear that we are still in this head and shoulders topping pattern. Very much actually. So this most recent candle, this week's candle, this is a hammer right here. This is a reversal signal. This is it. Like literally today, this is like the top. This is a reversal candle here. So this head and shoulders pattern is still in play. I fully expect it to play out here for 1,000 different reasons at this point. Again, no advice, and I'm a guy just with a crystal ball. But Mr. Market is greedy here. What could possibly go wrong? Fear and Greed Index from CNN. We are back into greed mode, folks. Pedal to the metal. Why not? I want to repeat this. I bring it up in every show. VIX futures term structure, highly elevated contract in October. Everyone, including myself, is expecting volatility to increase here. If we take a look at the actual VIX, it has been just like very calm, like so oddly calm, I would say. We're just ready for the next canister to explode here. You know, the one that exploded August 5th was just huge. We never get that high in the VIX. Like I said in previous shows, the last time we saw this was in COVID, and before that, the great financial crisis. The fire is burning, and we're ready for the next canister to blow up here. The VIX futures curve is screaming that right now. On to a little more personal charts. TLT had a pretty big down day today. I was expecting this to sort of be like a flag that would break out to the upside, and it did. It had a higher chance of breaking out to the upside, but this is clearly a breakdown to the downside. This is bearish for bonds. So bonds, by just basic charting techniques, TLT should actually be going down from here. I'm not worried or scared. I'm holding all of my positions in long bonds with leverage. I may end up getting more here, actually, depending on how low we go. But short term, it looks bearish on a day-to-day basis. The upside down version of this, TNX, the 10-year treasury yield, also breaking out of this channel here, looking bullish. 3 white soldiers is what these are called, and this is a 3 white soldier pattern, suggesting that yields want to move higher here, at least temporarily. I am a bond bull right now. I don't think that this will last. Obviously very similar, basically the same thing in the 30-year treasury yield. Now, while guaranteed securities are selling off, high yield corporate has zero fear. In fact, it looks like credit spreads actually tightened even more today than they've been tightening already. This is absolutely insane. I, at this point, feel like I would pay a lot of money to meet the people that are buying junk bonds right now and sending the price of these funds higher. Mr. Market has lost his darn mind. I'll just leave it at that. Alright, so let's try to finish up here. This is REMX. I have 5% of my own portfolio in this because compared to gold is at all-time highs, and the value of this fund, these are companies that mine other precious metals besides gold, and the value of this entire fund has been massively suppressed for over a decade, which is why I find it to be a very interesting place to be. I wanted to bring it up today only because there was a massive amount of volume, I don't know why. Maybe at the end of the month, this red bar here is the volume. Maybe it's the end of the month, maybe it's some fund manager, maybe it's nothing, maybe it's someone selling those stocks and then putting money into this fund instead. But this caught my eye. As you can see, the volume of today was almost 800,000 shares, which is about $32 million worth of assets that exchanged hands in REMX today alone. It's very strange. It was a heck of a lot of volume, and even more odd than that, I guess, is that it almost all seemed to occur at 2 o'clock and 3 o'clock. You have these two giant spikes here. Yahoo charts aren't always the most accurate with this kind of stuff, so you have to take that with a huge grain of salt. But the daily volume is correct here. And so that $32 million number is just so notable because the entire net assets of the fund are only $276 million. So in other words, if you were to sell this fund and all of its holdings, this is what the value of the holdings are of this fund, of all the shares of people that own it. Point is, it's about 12% of this entire fund exchanged hands today, which is a lot for an exchange traded fund. So somebody, yeah, again, I don't know what happened here, just found it interesting, wanted to point it out. That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.